Yeah, being that the latest rate hike coincided with summer vacation,
Hmm.
like we just said, it's typically a slow period anyways for sales, and prices kind of stagnate regardless for these couple of months. But coinciding with the rate hike, um, I don't know whether that price drop in average prices or sales, kind of activity is due to the, rate hike or just vacation or both, and so I think kind of the more telling will be after Labor Day, which is kind of prototypical of kids go back to school when families start, looking at buying again. So I'm kind of curious as to see whether that kind of has that same sort of pickup in activity or not.
Yeah, it feels at least like very similar to last December. Like it feels like this is kind of the dip or the calm before the storm. Like again, I just don't see any way that prices remain on a dip. Again, I said last week that there's a lot of that talk of that what they call a dead cat bounce. Like we saw prices really go up at the beginning of the year and then they kind of came down slightly. And then they're either going to go up substantially again or they're going to plummet. So I just don't see any way that the latter can happen. So I think if, as you said, Greg, if you're a home buyer getting into the market or an existing homeowner and you want to, upgrade, now is, I think, one of the better times. Let's say if you looked at the next 5 years moving forward, this is going to be one of the best times in the next 5 years to buy. If you have it all rolled out, you look at 60 months. If you rank them all from 1 to 60, I mean, the next 2 to 3 months, I think, are going to have to be pretty close to the top of that chart as far if you're looking at just the price of homes.
Mm-hmm.
All things considered, as we said, rates are going to come down, prices are going to go up. It's cyclical. Everything is going to work the way it usually does. It's unpredictable as to when it's going to happen. But I just
Mm-hmm.
don't see any way prices are going to continue to drop. And if they do, then there's going to be a resistance there where investors or whoever are just going to be like, okay, well, you're going to put these at 500,000. We're just going to buy them all.
Mm-hmm.
People are like, there's also investors waiting for those opportunities as well. So I just don't see any way it can drop below a certain threshold. And I think
Mm-hmm.
we're seeing that dip right now based on, as you said, rates, summer vacation, et cetera. But I just don't see any way come September, October, November, like by the end of the year, that we're not seeing prices back on the rise. So
There was a
Go ahead, Dave.
oh no, continue.
I was just going to say, are you guys seeing right now with the way that the rates are you finding that a lot of people are pushing for 5-year fixed yet, or are they still kind of banking on variable coming down and sticking with like 1, 2, 3-year fixed mortgages?
So definitely we get a lot of inquiries about 3 and 5 year, kind of in that same breath that they're looking at the 3 year because they don't believe rates will stay as high and they don't want to lock in necessarily to the full 5 years, and they're hedging that they will come down. And then in that same breath they're saying, well, what's their 5 year, because I'm also uncertain of what rates are going to do, and I kind of that stability for my budget is also enticing. There's a lot of misinformation or uninformed borrowers that believe that what the Bank of Canada is doing with adjusting bank prime or the overnight lending rate is directly connected with the fixed rate, which it isn't. And so kind of that conversation always comes into play, that it is it does have an impact a little bit on the bond market, but that fixed rates are tied to the bonds. So I think that's where people are, they're weary because they keep seeing the Bank of Canada raising rates, and so they're worried about that. Obviously, that's impacting a lot of things, but they don't believe that it's going to stay elevated for an extended period of time. I don't know if, Paul, you're seeing the same.
yeah, it is a challenging conversation to navigate right now. I mean, I'll say to clients straight up, like, this is a challenging conversation to have, because it is like nobody really knows where rates are going. If we've learned anything over the last 24 months or 18 months, even the experts saying what they say, it's not always accurate, if ever. So, I say if you're willing to take on any sort of rate risk right now, I still think I'm obviously very pro variable, and it becomes harder and harder to suggest it when there's a 1 to 1.25% difference from the fixed rates. But I'd say if you can take on any sort of rate risk, at least in my opinion, the likelihood of a variable rate staying at 6.3 for the next 5 years, I think is unlikely. I think the people that are locking into fixed rates I think are doing exactly what the banks are hoping. They know that there's a lot of people coming up for renewal. They know that they lost money over the pandemic with rates being at 1.25% and 1.5%. And I think locking a lot of people in at 5 years, 5.25%, 5.5% is excellent for lenders. I know they have to recruit them. That's by any means saying that they shouldn't be, they're a for-profit business. But I think once enough people have locked into those interest rates, that we'll start to see rates come down. Obviously, banks would never talk to regulators. That never happens. There's no conversations there. They're supposed to be independent. But these things tend to follow a certain trajectory, I guess. And I just feel like if you can take on rate risk, I think variable rate's going to be a good option. I think we will see variable rates come down before we see fixed rates come down. We were saying last week, maybe 9 to 12 months is the current prediction for variable rates to start decreasing. And yeah, I think the 2 and 3 year fix, when those were really hot, probably 6 months ago, lenders sniffed it out. They're like, okay, 2 to 3 years are hot. Let's, those rates went up. They're sitting in the mid 6s now in most cases. You can probably get the 3 year still at maybe 609, 619, somewhere like that. But most 3 years, 2 years are sitting in the, like I've seen some at 659, 669. Like they're not cheap, at least compared to the 5 year fix. So from the calculations I've done for clients, looking at the 5 year fixed rate, let's say a promotional rate of 519 compared to a 3 year rate of 659, you'd have to have a rate of 2 or 3% in your last 2 years to even get to a break even point for the 5 year, So people are, if you take a 3 year fixed rate, you're going to pay a higher rate for the first 3 years in hopes that rates come down in 3 years. But if they don't, then you're basically pigeonholing yourself. So honestly, it is tough to navigate because I think it's a gamble either way. If you take a shorter term fixed rate, you're basically hoping or gambling that rates are going to come down. If you take a 5 year variable, you're hoping the rates come down. But both ways, unless you take a 5 year fix, you're kind of rolling the dice a bit. So it's challenging. You really got to know what clients are willing to take on and what the goals are. If they just want a fixed static payment and they're comfortable with it, obviously going fixed rate. But if they're willing to take on some rate risk and want to kind of play the game, then I would still feel comfortable putting people into a variable if they understand that.
I think a lot of people are, in this climate, very risk adverse. But prior to obviously any increase with prime and all of that, they that is more challenging for them to recognize that variable has in the long term has won out historically. But I think really the most important is just the rate is whether you're going variable 3 year, 5 year. At the end of the day, whatever that rate is again, like we talked about last week. I'm mixing up whether it was last week or that other episode we did midweek of just budget, like it's fitting their budget. Regardless of what lender you're looking at, what rate, variable, fixed, term length, have it fit your budget for where you are and like go with that, what you feel comfortable with. If there's an ounce of you that's uncomfortable with, looking at a shorter term or looking at a variable, then don't do it. Because there is such uncertainty out there. There is no crystal ball. You got to go with what you're comfortable with and what fits your budget for where you are. And you can really kind of look at what's in front of you right now.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe because we'd really like that.